Today we're talking about how to prepare financial statements, whether it's condensed or consolidated financial statements or micro financial statements for smaller businesses. But I want to show you how you can prepare these financial statements without a software. And also, maybe you're not an accountant, so let's say you're a treasurer, for example, and you want to know how to read and present a set of financial statements, whether to your directors or to people that need those statements. How do you do it and how do you put that together? Let's get into it. Okay, so why do we prepare financial statements? Now, this is a compliance thing mainly. So essentially, financial statements are prepared to show the performance of the business and to show the net value of the business or the position of the business at a certain point in time. So you're showing the users what you've been doing in the business, the kind of transactions you've been having in your business, and you're being transparent about the activities in your business. Now, this can be quite useful. So while it's just a compliance thing that I've talked about that you are required to do and you have no option, especially if you have a limited company, but there are other benefits of preparing financial statements. So you can actually get strategic insights from financial statements. So for example, you want to invest in a company or you want to lend money to a company. You can look at their accounts and see whether they've been profitable. You can determine whether they'll be able to repay the money back if you were to give them money, because you can see whether they're leveraged or they've got too much debt in the business. So they're actually quite insightful to people or to readers of these financial statements and users that are invested in your business. In other words, stakeholders to your business. You can also use these financial statements as visibility or proof of life for your business. So let's say, for example, you wanted to get into a certain contract. Like these days, if you want to go, let's say, and get a vehicle in your business name, you cannot get one until you have existed and you filed accounts for at least maybe 2 years. So that is proof of life of the business. And so that's why those accounts are prepared. And you can use that as an advantage because you're preparing your accounts, you're staying compliant, you are showing other lenders or other interested parties that you are a responsible business owner. And so it is proof of life that works to your advantage actually. So those are some of the reasons why we would prepare financial statements, or you would as a business owner. So what does a set of financial statements look like? Now, I've put up here a template. You can see this is what it normally looks like. You'll have introduction, so company details that you will see, and then it goes on to maybe sometimes talk about what the business does depending on the framework. So you can elect which framework you want to use, but today I'm talking about the most basic forms. So you will have a balance sheet, and what this is showing, it's showing the net value of the business or the net worth of the business. So how much is the business worth to the shareholders or to the people that are putting the funds into the business? This is what's used as well by other stakeholders, like I said, that may be lenders, to see how much you have in your business and what the position is in the business. And then you will have notes or disclosure notes that are added at the bottom of the financial statements, and these are explanatory notes anyway, but they explain what's happening in the company and give context to the numbers that are presented. And that's what a set of financial statements would look like. Now, when you're preparing your financial statements, the one thing you need to know is that your assets and your liabilities are what make up the net value in the business. So that's what you need to show. So this is the equation here. Your assets plus your liabilities would show what the net value of the business is, or what the total equity in the business is. And that is exactly what you're working towards. And that's the equation you need to always keep in mind as we're going through this and as you're preparing your financial statements. So how do you prepare the financial statements? To start with, you need to put together all the transactions that have happened in the business. So this can be non-cash transactions or cash transactions. So cash transactions, hopefully you have bank statements and you can see, and hopefully you're using a bank account, but you can see exactly what's been paid for, what's been received in your business. In some cases, some people still use cash. You want to have kept records of what you've paid for in cash and what you've received in terms of the cash amounts you've received. Now, on the non-cash side, you're thinking about things that have happened in the business. So for example, you had assets in the business and you are charging depreciation. So you are saying you've been using these assets in the business, they've probably lost value. That's a non-cash item that you need to take into account. Or maybe you have done work for someone or a construction project, but they haven't yet paid for that phase of work. You have actually earned the revenue, but because you haven't received the cash, that will be a debtor. So in other words, they owe you the money, and those are non-cash transactions. So you need to put together all your cash transactions and your non-cash transactions, list them, and then you'll be ready to get started. Next thing you want to do is to categorize all of these transactions. What I mean by that, if you remember that equation that I talked about, you've got your assets and your liabilities, which will equal your equity or your net worth in the business. You are putting each of these transactions that you've put together into either one of these brackets. So it's either a movement in the asset or a movement in liabilities. And that will inadvertently be a movement in the equity or the net worth of the business. So you're categorizing that. Now, for your assets, you want to break it down further. What kind of assets do you have? Now, in any business, you would have the non-current assets and the current assets. The non-current assets are assets that are not easily tradable. So for example, properties or property investments, you can't convert them to cash easily. It might take some time. And for current assets, you have your cash, which is already cash, or you can have your debtors because you can chase those, or you can trade debtors, actually go and sell off your debtors and get cash instead. So those will be your current assets, something that you can quickly convert into cash. For your non-current assets, you also maybe want to break it down further. What kind of non-current assets do you have? So you likely have tangible assets, so assets that you can physically hold and touch, and non-tangible assets, assets that are more not tangible. So these are assets like maybe intellectual property, they're assets like your copyright rights or admin rights to something, or the value of your contracts, for example. So those are not tangible, but they bring value to your business because you're generating business from those assets, and that's why they're defined as an asset. Same thing with liabilities. You have your non-current liabilities and your current liabilities. And then in your non-current liabilities, you want to break it down further. So put it into categories. You're going to have your bank loans, for example. You're going to have maybe a mortgage, which is also like a bank loan. You might have long-term loans. So essentially, non-current liabilities are liabilities that are long-term. So ideally maybe 5 years or 10 years. They're not due in the next 12 months or in the next 16 or 18 months. Your current liabilities are those that are due in the next 12 months. So let's say a bank overdraft, or your short-term creditors, or your credit cards, because those are due and can be due immediately. Those are classified as current liabilities. So you want to categorize all of those transactions that we've put together, put them in each of those categories. If you're taking transactions from the bank statement, it already means that cash has gone out or it has gone in. But what has it gone out for? Or where has it come in for? And that's where we're categorizing. So the movement in the cash will already impact the cash or the assets. But the other side of the movement, you will have to then categorize that. And that's what we're trying to do here. Same thing with the liabilities. We've already categorized the cash when it's come in or when it's gone out, but where has it come from? And that's where we're categorizing as well. Now, once you've categorized all your transactions, make sure it makes sense and it's put through in the right categories in your business. And then you sum it all up together. So you should be able to see, for example, the movement in the cash. So all of those transactions that you categorize, you need to sum them up and make sure that they are making sense to you. You're looking at your total movements in cash, for example, because you already have your bank statements. What you had, and this is what we call a reconciliation, what you had at the beginning of the period or of the year, less all the transactions that have happened should show you the balance that you have at the end of the day. And then you're also looking at the sum of, let's say, the transactions that have gone to your long-term loans. Do those sum up what you see on your loan statement or on your overdraft statement if it's a long-term loan, for example? So you're reconciling to make sure that it makes sense. And these are checks put in place to make sure that you haven't missed anything. So try to get the statements from your third parties, whether it's creditors, sometimes debtors, for example, or credit card suppliers. You get the statements and they help you check to make sure that you've categorized everything in the right place. This is an essential step in preparing your financial statements because it ensures completeness of your financial accounts. So it's just making sure everything has been included, nothing has been put in the wrong place. Once that's done, you've summed it all up, now you can see how it's starting to flow into the right categories, and you can pre-populate it, or you can populate it into your pre-prepared set of accounts. And that's what your numbers would look like. So once you've summed up all of your categories and your transactions, you now want to move on to the disclosures. So these are giving context to the numbers that you have prepared and you have put together. So for example, you have put together, the admin expenses. How much of that is from employees and how many employees do you have? So it gives users a bit of understanding into what's happening, or a bit of insight into what's happening in your business. Or for example, another note would be in your non-current assets, you break it down. What is that made up of? Okay, it's made up of fixtures and fittings. It's made up of office equipment. You've got computer equipment. Maybe you've got plant and machinery as well. You're breaking it down so users can see by category how much exactly relates to which category, and you're showing that in your disclosure notes. If you are owned by another company, so you're a subsidiary of another company, the very last note in your disclosures should also show who the ultimate controlling party in your business is. And this helps the users of financial statements understand who is controlling this business ultimately. And if they want, they can look more into that business. So I hope I've broken down the steps of how to put together a set of financial statements quickly, and what's important and what you're trying to do. And this is easy, particularly if you have a low volume of transactions. If you have a high volume of transactions, I would not recommend doing this manually because you will miss things, you will categorize things likely in the wrong places. So I would recommend getting an accounting software, or at least a bookkeeping software that can track all the transactions, and all you have to do is categorize, but it will group everything and sum everything up for you. But not everyone is for software or automations, so you can do this manually, especially maybe if you're a very small startup and you're still trying to understand what the market is about, what your business is about, and there hasn't been a lot of transactions in your business. You can do this manually, but otherwise look for a bookkeeping system that you can use, or look for an accountant who can do all of that work for you, and you should be able to prepare your financial statements that you can get value from. You can prepare and meet your compliance deadlines. You can have finance because your lenders are happy that you're meeting the obligations and they understand, or there is transparency about what's happening in your business as well. So I hope that was helpful, but if you have any questions, drop them in the comments below or ping me and I will be able to assist you.